Hey everybody, welcome back to Tim Travels. It's Terry, your host. Unfortunately, I'm still coming to you from the Garden State. Not because I don't like New Jersey, but just because I couldn't seem to get a load put on me by night dispatch, because that's a subject for another video. Anyway, so I wanted to tell you before we get into today's, what we were going to talk about. I wanted to tell you about the original Teamsters and the original kind of long haul trucker guys. They weren't really truckers, but they were Teamsters. So one of the things that is kind of like this iconic thing from the American frontier is the Conestoga wagon. Now, a lot of people probably associate the Conestoga wagon with people crossing the prairie, crossing the plains and stuff, but that's actually not correct. The wagons that they used to cross the prairies and the plains were smaller than Conestoga wagons, and I'll explain why in a minute. And they were often just farm wagons that they then put a covering over, like a canopy, to transport their goods. Those wagons are sometimes referred to as like prairie schooners, and they were smaller, usually about 10 feet, the body of it about 10 feet long, about 4 feet wide. But Conestoga wagons actually originated in Pennsylvania, in Lancaster County to be exact. And they were made by German and Pennsylvania Dutch immigrants. And they were so named because of the Conestoga River, which runs through Pennsylvania, and also there's a township called Conestoga Township. And if you happen to go into Lancaster County, like if you're in Ephrata, where 222 runs past Ephrata, if you were to go to the east, you would run right over the Conestoga River and probably into Conestoga Township. So anyway, those wagons were much more substantial than the prairie schooners. Sometimes they were like 16 to 18 feet long. And the bottoms of them were bowed to keep cargo from tipping over on the rough roads. Because keep in mind that out west on the prairies, there weren't really roads. People just went like cross lots. They were just going across areas that maybe had no roads. Now, there was an Oregon Trail, there was a California Trail, but this was much later than really the Conestoga wagons were in great use. But the Conestoga wagons, properly constructed, could handle up to like 12,000 pounds. And so 6 tons of cargo. And these were wagons that people used to move stuff from like Pennsylvania over the mountains into like Ohio, when Ohio was being settled. And so we're talking the early 1800s. So I talked about the Western Reserve that was what is now in Ohio. But people were starting to move into Ohio, into Kentucky, into the areas of the Ohio Valley, so southern Indiana. And these wagons would bring building materials, other hard stuff. They probably in season, like maybe transported barrels of apples that, when the weather was cooler, something that they could keep preserved, something that wouldn't spoil. They would usually get about 15 miles a day. And here's the thing. The operators, the Teamsters, so-called because they ran a team of mule or oxen, although there was a kind of hybrid breed of horse called the Conestoga horse. And that breed just eventually like kind of died out because there wasn't really a need for them. Because as commerce increased and technology increased, we started to get more product moving by water and then by train. And really what put the Conestoga Teamsters out of business were trains. Just made more sense, right? But here's the interesting thing, and I was thinking about this because I was listening to trucker Richie Rich last night talking about freight rates out of Florida. And he was talking about how some guys are running for like 40 cents a mile and stuff. So here's what the Teamsters, well, the owner of the Conestoga Wagon would, well, let me back up. So the Teamsters didn't ride on the wagon. They actually walked beside the wagon, and the wagon had, in the middle of it, it had a handbrake. So they would stand by the handbrake. And the other thing that I found interesting about these wagons is the lead animal would always be on the back left. So if you had a 4 oxen team, it would be the second row back and on the left. That was the lead animal. That was the turning ox. And, you know, so he could control the turning ox from where he stood by the brake. He would have like a, you know, a stick or a little switch or a whip. And you know, and if you know oxen or even just beef cattle, you can whack them, they don't even care. Barbed wire, they don't care. But he would guide that turning animal. And I've read that it's possible that that's why we drive on the right-hand side of the road in the United States, because the Teamsters would drive their team on the right-hand side of the road. They would stand on the left side of the wagon, and their turning ox or turning mule would be on the left side. So that would make sense, because they wouldn't want to be on the ditch side or the edge of the road. They'd want to be in the middle of it. So I don't know if that's how that started, but it makes sense if you think about it, right? Like this was a different country than England, and we just had different needs. So they walked in the middle of the road on the left, and the team and the wagon was on the right-hand side of the road. So anyway, the price that these guys would get paid is they would get $1 per hundredweight per 100 miles. So I was like, well, how much is, you know, so how much could they make? And, you know, like I said, they only went about 15 miles a day, you know, which is a long way hauling 12,000 pounds, especially if you're going up and down through the Appalachians and through the foothills. But if you do the math on 12,000 pounds at 100 pounds per 100 miles for $1, it works out to be a fully loaded wagon would be charging $1.20, $1.20 per mile. This is in the early 1800s. There are drivers out here today charging $1.20 a mile or less, right? I mean, think about it. If somebody wants to move 12,000 pounds of cargo, especially if it doesn't take up the whole trailer, they don't want to, you know, they don't want to pay $1.20 a mile. They want to pay you like 80 cents a mile. So I guess that's like, that makes us look bad, because Teamsters were getting $1.20 a mile. Now they only made it 15 miles a day, but think about it. That was still a lot of money. And, you know, the wagon was a big investment, just like a tractor trailer is a big investment. So, yeah, I just thought that was really interesting. All right, so let me take a brief pause. I'll be right back. Okay, so, and by the way, I'll tell you a little technical aspect of my videos. So I had a hoodie on, but I was starting to get warm. And when I took my hoodie off, I had a light gray Prime t-shirt on. But there's just enough sunlight that it was making me look like all whited out. So I changed my shirt into this darker blue. So, and that's why I got the visor over here. So we're talking about insurance today, and I was asked a question because I did a little thing about workers' comp. And, you know, I said there's workers' comp policies. So I went back and I looked through my lease to better understand. I had talked about the insurances, but I wanted to better understand what was there. So there is that group insurance policy, and, you know, it has the hemorrhoid coverage, and it has some accidental death coverage and stuff like that. But I looked at the workers' comp portion of it, and I do not believe that the independent contractor, who, like, so you're a member of an LLC, let's say, so you're the independent contractor. I don't believe that you personally are covered by Prime's workers' comp policy. If you have a TNT or a maybe not a PSD student, although I still think a PSD student could file a workers' comp claim, even though they're not technically an employee. I think the law would protect them. But if somebody's a TNT student, they're an employee of Prime, so they definitely would have coverage under your lease, and I think that's why the policy is in place. So the question is, do you, if you're an owner operator, lease operator, and then we'll just say independent contractor covers all that. If you're an independent contractor, do you need to have workers' comp and for an on-the-job injury? And the answer is no, you don't legally have to have it, but it certainly is a good idea, and you could get a policy on your own. Now, I don't know how much that policy is going to cost because it's based on the state you live in. Workers' comp is state-based, but it might be worth the investment. If you get hurt on the job and you can't drive your truck, at least at Prime, you could just, if it was going to be long term, you could just turn the truck in. But that brings us to the question of, okay, what if I can no longer drive? Because workers' comp isn't going to necessarily, it's not going to take care of that. It's going to pay you for your injury. But what if you weren't injured on the job and couldn't drive and couldn't work? What are you going to do? Well, the answer is that you're either going to starve and or you're going to have to wait for Social Security disability to kick in. And I've talked about this several months ago, but I'll talk about it again. I used to work, in addition to practicing law, I used to work at MetLife, and I was a financial advisor. I had licenses to sell life and disability insurance. I also had all my securities licenses. So I did investments, insurance products, which includes life, disability, long-term care, and annuities. Yeah, annuities are insurance products. Okay, so I feel like I'm a little bit qualified to talk about this. And by the way, if you're one of the haters, first of all, if you've never had insurance licenses and you really don't understand these products, just don't put a bunch of comments on here saying, oh, this product's a ripoff and this product's terrible and that makes no sense, because you're just talking about yourself, and I'll tell you a story about why these products matter. So when I worked for MetLife, our family had a friend, and she was pretty close to us. Our kids used to go hang out at her house, but she was single. She was somebody we went to church with, and she had a good job. She was college educated, had a master's degree. She had a professional, job, and her family was fairly, comfortable. Her parents were fairly comfortable. Her dad was a bright guy, but he also, good at business, but he had also played in the NFL back in the day. So her mom and her dad were in good shape, and so were her siblings. And so she had some investments that she wanted to move over and have me take care of for her. So I said, okay, great, and we sat down. We actually did it at my house, and I asked her about, life insurance, because I did my standard, try to understand the client, know your client, right? KYC. That's actually the law. And she's like, well, what do I need life insurance for? I'm single, my parent, who would I leave the money to? And I kind of let it go because she was, she was in good health. She was physically active. I didn't want to push it because a lot of times that's a touchy subject, and, people don't want to be sold, right? People love to buy things, but they don't want to be sold. So I was like, okay, well, that's, we don't have to deal with that. I said, but it's always better to buy life insurance when you're young, because the price points are significantly lower, and over a lifetime, for the same amount of coverage, you'll pay significantly less if you buy it in your 20s than if you bought it in your 30s or 40s. So anyway, I let that go. A few months pass by, and I get a call from my wife. I'm at work. I get a call from my wife, and she says that our friend has breast cancer. Well, it turns out that right before she was diagnosed, she got married. And she actually was the superior bread earner. In other words, her husband didn't earn nearly as much as she did. And she had moved out to the West Coast. And of course, once she got that diagnosis, she wasn't going to be able to get, life insurance or anything like that. But unfortunately, when they caught the cancer, it was really advanced, and she ended up passing away at a young age. And the last several months of her life were financially difficult, in addition to being just difficult, generally speaking, because of the cancer. But I always look back on my decision not to press her a little bit further about getting some life insurance, because she certainly could have afforded it. But here's why I feel bad about it, and I have regrets, is because when you get a life insurance policy, when you get a quality life insurance policy that's not, guaranteed issue or anything, you get a physical. And part of that physical, it's not too intrusive, but they do take your blood and they check your blood. I don't know if when she had gotten a physical, if she had said, oh yeah, let me get some life insurance, if she would have gotten the physical and in the blood work, they would have found like elevated white blood cell count, indicating that her body was fighting some kind of infection or disease. And I don't know if they would have said, hey, we see this, we think you should just go to your doctor. Because insurance companies will, if there's some issue, they'll tell you the results. And by the way, if you try to get an insurance policy and say you're a non-smoker, they do check your blood and urine for nicotine. But anyway, she didn't get a life insurance policy. So I don't know if they could have caught it or not. But the other thing, even if they didn't catch it and they issue the policy, it would have made her last few months much, much easier. And the reason it would have is because on quality life insurance policies, and I'm talking about big, solid companies, there's a free policy rider. It's called an accelerated death benefit rider. And what the accelerated death benefit rider does is it says, if you have a terminal illness, and you have a note from a doctor that says this person's gonna, has 6 months to live, 9 months to live, the insurance company, upon receipt of that, will pay out a fairly significant portion of the death benefit in advance of your death. They will pay out sometimes like 50%. So if she would have had, because she was a fairly high wage earner, if she'd have had a $500,000 policy, I'm sure that MetLife would have paid out, $250,000, $300,000 to her, and that would have made her life a lot easier, because there were a lot of people that kicked in, just had to drop what they were doing to try to help her, take her to the hospital and doctor's appointments and treatments, and it would have made her life a lot easier. And so that's my story, and it's unfortunate, it's very sad. Life insurance wouldn't have changed the outcome, but it would have made things easier, and both for her and for the people she left behind. So that's my story. Okay, so getting back to what we were talking about on the, oh, you're disabled side. So there's two kinds of disability insurance, right? Short-term and long-term. If you're an owner-operator, I don't necessarily think that you need short-term disability. And the reason I say that is because if you're running your business properly, and I said this on Lyle's channel the other day, if you don't have a month, if you can't go a month without income from a trucking business and still, pay the bills and put food on the table, then you need to really reassess what you're doing. Maybe this isn't the business for you, or maybe you just need to quit spending so much and put some money aside, okay? And one easy way to do it is Prime has an emergency fund if you're at Prime. But even if not, just put money into a bank account, right? And don't spend it, right? Save it for your taxes, save it for a rainy day, save it for an emergency, whatever it is, right? But long-term disability is a different story, and I will tell you another real-life story that I'm familiar with. My wife used to do home health care, and one of her patients, and this has been several years ago now, but one of her patients was a guy that was at the time in his, I think, early 50s. He owned a business, he owned a custom transmission shop, and had a Harley, just was living the life, right? Had a successful business, had employees. And one day he thought he had an ear infection. Well, the truth of the matter was he had a brain lesion, and that brain lesion ended up disabling him. It had to be operated on, and he lost a lot of function. He couldn't work, couldn't go to his business. He basically had to turn stuff over to his employees. I think his sons worked for him, but it was a huge hit for him. And I think, but for the fact that his girlfriend, and luckily she was his girlfriend and not his wife, she had a good job and so could keep a roof over their heads. But the interesting thing is that the reason my wife became his caregiver is because he had to go to the state for assistance. And, that was a guy that if he'd had a good long-term disability plan, he could have had income coming in. And by the way, he still would have needed help, and he probably still could have gotten it. But, you can't count on the government to step up, at least right away. Social Security disability does pay out, but you got to jump through a lot of hoops. There's a reason why there are lawyers who do disability work. And one of them is because the Social Security Administration is hard to deal with. Also, on a permanent disability, the Social Security Administration, at least when I was doing this full time, they wouldn't even accept your application for disability, full disability, meaning you can't work, until about 9 months from the date of disability occurred. Now, they would retroactively pay you once they decided what your claim was. And once they said, okay, yeah, this person needs to be on disability, they would retroactively pay you. But how many people want to go 9 months or longer? That's once they take the application. Realistically, it's probably going to be about a year. Now, you might get this big old check, but what if in that year you lost your car, lost your home, you're living in somebody's RV in their driveway because you've had no income for a year? I mean, that's going to be a crappy year. In addition, forget about the fact that you're disabled. Forget about the fact that your life has changed appreciably. You've had no income for a year. That's significant. That's why long-term disability is, I think, almost a must for anybody that can't, already doesn't have a pile of cash or could retire anyway. So maybe if you're at age 62 and you're like, hey, look, if I had to retire today, I could. I've paid in Social Security. By the way, Social Security is, I know a lot of people are going to roll their eyes, but it's going to be there. And by the way, most people take it at 62. I don't necessarily advise that. I advise getting to full retirement age. But some people take it at 62, and sometimes that's a good call. If you have a really unhealthy lifestyle, you don't have longevity in your family, maybe taking Social Security at age 62 would pay off for you. Maybe, just retire and enjoy the years you got left. If nobody in your family has lived past 70, yeah, you should take it at 62. In my case, my dad lived to be 87, and he had way unhealthier lifestyle than I do. So anyway, that's disability. I think that's a good idea. The other insurance that kind of isn't related to this, but cargo claim. So we know the trucks are insured on the lease, and there is cargo claim insurance, but the way it works at Prime, at least, is if there's a cargo claim, you have to pay the difference between what Prime gets reimbursed by its cargo claim insurance carrier and by what the actual claim was from the shipper or the receiver. So if you have a load that's worth $50,000 and you do something that causes a loss of that load, then you're going to have to, and let's say Prime only gets $25,000 from their carrier, you're going to owe Prime the other $25,000. And so maybe you want to consider cargo claim insurance, although you're probably only going to be able to get cargo claim insurance as part of a package that includes other property and casualty insurance on the truck. So just food for thought. Okay, so let's talk about life insurance. And I got the VAP board like I promised. And there's two kinds of life insurance. There's permanent insurance, and there's term insurance. Okay? Term insurance is pretty simple. It's insurance that you're leasing, right? It's insurance that you're buying for a period of time. So if somebody says, I have a 20-year term policy, what it means is the policy's in effect for 20 years from the date of issue. It's going to be a level premium, meaning whatever the payment is on it is going to stay the same. If it's $169 now, it'll be $169 18 years from now. It gives you a set death benefit. If the death benefit is $300,000 when it's issued, that'll be the death benefit the entire time. Now, some term policies do have a provision that allow you to continue beyond the term, but then the premiums go up exponentially. That 169 in the 31st year of or let's say it was 20 year, I said 20 year. In the 21st year of the policy, that 169 a month is going to go to like 330 a month. Then in the 22nd year, it's going to go to like 580 a month. Okay. Now, if you're terminally ill, you would want to keep that in place. It'd be worth, if you think, you're going to be gone in a couple more years, it'd be worth just putting the money into it. Okay. But that's not the best way to go about that. The other thing is some term policies have what is called a convertibility feature, and it allows you to convert all or a portion of the term life insurance during the term to a permanent policy. And typically that conversion is to what is called a whole life policy. And I'll talk about that in a second. If you've gotten older and you want to keep insurance, you want to have permanent insurance that lasts as long as you live, so that you can leave some money behind to somebody or something like the SPCA, then you should convert part of your term policy, or all of it if you want to. If you have the money, just convert it all. But if you want to to start out with a good insurance plan, and especially if you're young. If you're in your 20s and you're a non-smoker, you can set yourself up for life and for death fairly inexpensively. And when I used to do this, I used to be able to model a combination of permanent and term life insurance, usually with a whole life product and a term, where the whole life would accrue enough value that it would throw off in earnings, and I'll come back to the earnings in a second, enough money to not only pay its own premium, in other words, it pays for itself, but also eventually throw off enough money to pay the term premium at the same time. So like a 30-year term policy coupled with a whole life policy, I used to be able to get people to like even after about 12 years. In other words, after 12 years, they weren't making payments on any of those policies. Why? Because the whole life policy was earning them money, and I'll explain how that works. So permanent life insurance, you have a couple of varieties. I have 3 listed here, but the bottom 2 are kind of the same, but not. Okay, so this is whole life, and it's insurance that lasts for your whole life. In other words, as long as you pay the premiums, it's going to be there. Now, it's possible to pay the premiums for a period of time and still have the policy remain in effect till you die because the policy has accrued enough cash value. The other kind of permanent policies are what are called variable universal life, or VUL, or universal life. Universal life has, for the past probably 20 or 30 years, not been a great idea. Why? Because universal life was tied to interest rates. Now, when interest rates were high, the prime rate was high, universal life policies did well for their policyholders and earned money. But with interest rates so low over the past, 15, 20 years, they haven't done well. There may be a resurgence of them, but I still don't care for them that much. In fact, I never sold one to anybody because it never made sense. The other kind of universal policy is a variable. Now, variable policies are tied to a performance in the stock market. They could be great policies, or they could be not so great policies. It just depends on the investments that you choose to put into the policy. If you're looking for a permanent life insurance policy, a VUL can be a way to put money aside pre-tax, because if you run your own business, you have money and the company can buy these policies. The company can pay the premiums on them. And therefore, if you have a pass-through tax entity like an LLC, you don't have to pay taxes on the money that you paid into a policy that is owned by the company. And you say, well, why would the company own the policy? The company would own the policy to insure you. Now, you could make the beneficiary of the policy the company, okay? And you say, well, I want it to go to my wife. Well, guess what? If you die and you have your company set up right, your wife is going to control that company when you pass away, or your beneficiaries are, right? It's part of your estate because you own equity in your own company. But for tax purposes, if you said, hey, I'm going to pay $1,000 a month into a permanent life insurance, whether it's a VUL or a whole life, that $1,000 a month is just a business expense, right? It's not personal income to you. But because the company owns the policy, and keep in mind that a company can be an owner of the policy and not be the insured, and not even necessarily be the beneficiary. So there's 3 different parties on an insurance policy: owner, insured, and beneficiaries. Could be more than one, could be several, okay? But let's go back and talk about whole life, okay? Whole life, one way to look at it is that it's like buying into a bond portfolio. Now, will you get as big a return on investment investing in whole life as you would into, let's say, tax-free municipal bonds? The answer is no. Why? Because it provides you also with a death benefit. But here's the great thing for a small business owner when you're talking about insurance. A whole life policy allows you, let's say it's $1,000 a month is the premium. You say, that's crazy. Yeah, but what if I told you that, in your 50s, you could start out with a whole life policy. You could pay $1,000 a month into it, and these numbers are just placeholders. And it had a $100,000 death benefit. But that death benefit, as you make the premiums, continues to rise. So by the time let's say you start it when you're 55, by the time you're 65, the death benefit is up to $212,000. And the policy has a cash value of $52,000 because you've been making these $12,000 a year premiums for 10 straight years as a business expense. Well, guess what? That 52 grand is accruing value. That cash value is going up tax free. It's not just tax deferred, it's tax free. And here's why. If you got a policy with a death benefit of $212,000 and $52,000 in cash, and you're like, you know what? I want to buy another truck and I want to put 40 grand down. I wouldn't necessarily, that's just an example. I wouldn't borrow against the policy just to buy another truck. But let's say you wanted to buy a retirement home and you wanted to put 40 grand down. You send a letter to your insurance carrier and you say, hey, I want to borrow $40,000 from this policy. Okay, you're borrowing from your policy. You're not taking money out of a 401k or an IRA. You're not paying any interest on that money, right? And then, so your death benefit remains the same, and you do have the option to pay that money back. However, since you borrowed it from a whole life policy as opposed to, say, borrowing it from a 401k, you don't have to pay it back and there's no penalty. The only thing that would happen if you borrowed that $40,000, right, is that if you died before paying it back, they would just net that loan out of the proceeds. So instead of getting $212,000, your family would get, $172,000 because they'd net out the 40 grand that you used to put a down payment on your condo in La Boca Chica. So it's a great vehicle if you need life insurance, and you do. It's a great vehicle to move money from your corporation into something of value that over time is going to increase in value and provide your family or your loved ones or your beneficiaries, SPCA, a death benefit. It's something that I believe in, and coupled with a term life insurance policy can be a great vehicle. So you already have investments, let's say in a SEP IRA or a personal 401k. And by the way, there are big changes coming to the 401k in new legislation. I'll probably talk about that differently because it's actually going to impact independent contractors too. But using two life insurance products, you can actually save for the future, have a source of cash if you need it, and provide a death benefit. Because nothing sucks worse. The only thing that sucks worse than having a loved one and a wage earner die is finding out that the only life insurance they got is that crappy little $15,000 policy from their company that cost their company zero. Basically zero, right? Because what happens is big insurers who want to do group policies, they provide that de minimis, tiny, insulting death benefit free of charge. the company really is not paying any premiums to get you that death benefit. They get it free because they're giving that insurance provider access to their employees to sell them other insurance and other products. And trust me, in a group policy with a $15,000 benefit, even if you were paying it, it'd be like, 89 cents a week, because it's such little amount of insurance, and it's in a group policy. So it's the law of large numbers, which is how insurance companies work. So anyway, I hope that was helpful. If you got questions, shoot me a message, shoot me an email. I have a very good friend, guy I was in the Navy with. He's a retired Navy commander. He was a SEAL, or I guess he still is a SEAL, because once you're a frogman, I think you're always a frogman. He just doesn't run as fast or do as many pull-ups as he used to be able to. Although he, back in the day, the guy was a monster, because, I knew him when he was young. Now he's middle-aged. And he has a haircut basically like mine. He sort of looks like, yeah. But anyway, he's a great guy, and, he works for New York Life, which is a very solid mutual company, and he would be able to help you. So I'll be happy to pass along his information. One of these days, when I'm up in New Hampshire where he lives, I'm gonna might do a live show with him or something. He's a great guy. So anyway, thanks for tuning in. I hope this was helpful. It probably engenders some questions, so ask away. If I can't answer them, I'll get my friend Mark to chime in. And he's the pro now, and it's what he does for a living. So thanks for tuning in, Tim Travels, and we'll catch you next time. Bye.